Pick up the thing nearest to you that you bought from a grocery store. Anything. A bag of chips, a bottle of juice, a box of cereal, a container of yogurt. Hold it in your hand and look at it. Really look at it, not at the brand, not at the nutrition label. Look at the size of it. Feel the weight of it. Now I want you to think back 5 years. Think about the last time you held this exact product in 2021. Does it feel the same? Does it look the same? You are not sure, and that uncertainty is the entire point. Because something happened to that product between then and now. Something was taken from it, quietly, carefully, deliberately. And the reason you are not sure whether it changed is because you were never supposed to notice. You have noticed something though. Not about any single product. About everything. About the grocery trip itself. You used to fill a cart for $150. Now you fill the same cart, or what feels like the same cart, and the register says $220. You look at the receipt in the parking lot, and you cannot find the mistake. Nothing on the list seems unreasonable. Nothing seems extravagant. You bought the same brands you always buy. You did not add anything new. You did not treat yourself. You bought groceries. The basics. The stuff that keeps a household running for a week. And somehow the number at the bottom is $50 or $70 higher than it was 2 years ago, and you cannot point to a single item and say that is the one. That is where the money went. The increase is everywhere and nowhere. It is distributed across every item in such small increments that no individual price seems wrong, but the total is devastating. And you stand in the parking lot looking at this receipt, and you feel something that is hard to name. It is not anger exactly. It is not sadness. It is a kind of vertigo. A feeling that the ground shifted beneath you while you were standing still. That the rules changed and nobody told you. That you are playing the same game with the same strategy, and the score is different, and you do not know why. I want to tell you about a woman named Diane. Diane is 41. She is a dental hygienist in Columbus, Ohio. She makes $59,000 a year. She has 2 kids, 11 and 8. Diane is not a coupon clipper. She is not extreme. She is a normal person who buys normal groceries at a normal store and tries to feed her family without thinking about money every single second of every single day. 3 years ago, Diane's weekly grocery bill was about $140. Today it is about $210. That is an increase of $70 per week, $304 per month, $3,640 per year. Diane did not get a $3,640 raise this year. Diane's rent went up. Diane's car insurance went up. Diane's electric bill went up. And now her groceries went up by $3,600, and she is sitting at her kitchen table at 11 at night, moving numbers between columns on a spreadsheet, trying to figure out which bill she can pay late this month so the math works. And here is the thing that is making Diane feel like she is losing her mind. She checked the prices. She went back to the store and she looked at the prices on the shelf, and some of them went up, yes, but not by enough to explain the total. The cereal is $4.29. It was $3.99 2 years ago. That is 30 cents. The peanut butter is $5.49. It was $4.99. That is 50 cents. The orange juice is $4.79. It was $4.29. Another 50 cents. She added up all the price increases she could find, and they accounted for maybe half of the increase in her total bill. The other half is a ghost. It is in the receipt, but she cannot find it on the shelf. It is costing her real money every single week, but it has no price tag. It has no label. It exists in the space between what she thinks she is buying and what she's actually taking home. Diane is not bad at math. Diane is experiencing shrinkflation. And the reason she cannot find the other half of her grocery increase is because it is not in the price. It is in the package. The cereal box that used to be 16 ounces is now 14.8 ounces. The price stayed the same or went up slightly. But the box got smaller, not dramatically. Not enough to see on the shelf next to the other boxes. Just enough to remove 1.2 ounces of cereal from every box sold in every store in the country without triggering the pattern recognition system in the human brain that would cause Diane to notice and feel cheated. The peanut butter jar that was 18 ounces is now 16.3 ounces. The shape of the jar changed slightly. The bottom is a little more concave. There is a little more air between the lid and the surface. The label is the same. The color is the same. The brand is the same. The price is the same. But there is less peanut butter in the jar. The orange juice that was 52 ounces is now 46 ounces. The bottle is slightly taller and slightly thinner. It looks the same on the shelf. It feels close enough in the hand, but 6 ounces of orange juice disappeared. And Diane is paying the same price for less product, which means the real price went up, which means Diane is experiencing inflation. That does not appear in the price, which means Diane cannot see it, which means Diane blames herself for the math not working, which means the system is functioning exactly as designed. Shrinkflation is the practice of reducing the size, weight, or quantity of a product while maintaining or increasing its price. The term was coined by British economist Pippa Malmgren around 2009, though the practice itself is as old as packaged goods. The mechanism is simple. A company faces rising input costs, whether from raw materials, labor, transportation, energy, or currency devaluation. It has two options. It can raise the price, which consumers notice immediately and which triggers comparison shopping, brand switching, and public backlash. Or it can reduce the quantity, which consumers almost never notice because the human brain processes price as a number and quantity as a physical impression. You read the price, you feel the size. And feelings are easier to manipulate than numbers. The math of shrinkflation reveals a hidden inflation rate that is significantly higher than the sticker price suggests. Let me walk through a specific example with real numbers. A box of cereal is priced at $4.29 for 14.8 ounces. 2 years ago, the same box was priced at $3.99 for 16 ounces. The visible price increase is 30 cents, which is 7.5%. That is what shows up in the Consumer Price Index. That is what the Bureau of Labor Statistics records. That is the inflation number that gets reported on the news. But the real cost increase is not 7.5%. The real cost is price per ounce. 2 years ago, you were paying 24.9 cents per ounce. Today, you are paying 28.9 cents per ounce. That is an increase of 4 cents per ounce, which is 16.4%. The real inflation on that box of cereal is 16.4%. The reported inflation is 7.5%. The difference, the 8.9 percentage points that vanished, is shrinkflation. It is inflation that is real, that costs you real money, that reduces your real purchasing power, but that is partially invisible in the official statistics because the BLS uses a methodology that attempts to adjust for quantity changes, but does so imperfectly and with significant lag. Now multiply that across an entire grocery cart. A study by the Bureau of Labor Statistics found that between 2019 and 2023, approximately 36% of products in the food and beverage category experienced some form of downsizing. A separate analysis by consumer research platform DataSembly tracked over 200,000 product listings and found that the average size reduction was approximately 10%, while the average price increase on the same products was approximately 12%. When you combine a 12% price increase with a 10% quantity reduction, the effective per unit cost increase is approximately 24%. That is the real inflation rate on those products. The number that shows up in the CPI captures the 12% price increase. It does not fully capture the 10% quantity reduction. The gap between what you are told inflation is and what inflation actually is on the products you buy every week is the shrinkflation tax. And it is a tax that falls hardest on the people who can least afford it, because lower-income households spend a larger percentage of their income on groceries. A household earning $200,000 a year spends approximately 8% of income on food. A household earning $40,000 a year spends approximately 35% of income on food. When the real inflation rate on food is double the reported rate, the household spending 35% of income on food is being taxed at double the rate of the household spending 8%. Shrinkflation is a regressive invisible tax that transfers wealth from the bottom of the income distribution to the corporate profit margins at the top. The corporate earnings data confirms this transfer. In 2022 and 2023, during aggressive shrinkflation, major food companies reported record profit margins. PepsiCo reported a gross profit margin of approximately 54% in 2023. Nestlé, 17%. Mondelez International, making Oreos and Cadbury, reported a gross margin of approximately 38%. These companies weren't shrinking packages to survive. They were shrinking packages to expand margins. Input cost increases they cited were real. Commodity prices and transportation costs did rise. But price increases and quantity reductions exceeded input cost increases significantly. The difference went directly to profit. A report found corporate profits accounted for 53% of inflation from 2021 to 2023. More than half of grocery store price increases were not costs passed through. They were profits extracted. Shrinkflation was the preferred extraction method because it is the one you cannot see. Unit pricing, legally required on shelf tags, was designed to make this visible. This small print is supposed to be the consumer's defense against shrinkflation. But implementation is inadequate. The unit price is in a font size requiring reading glasses. It's positioned below the large, bold sale price, designed to capture attention. The unit of measurement is inconsistent across brands, even within the same brand. One yogurt is priced per ounce, the next per quart. One paper towel per sheet, the next per square foot. The system meant to protect you is technically present, but practically useless. It exists so regulators can say information is available. It's formatted so consumers cannot use it, especially when standing in an aisle with 2 kids and 15 minutes to finish shopping. Shrinkflation is not independent decisions by companies responding to market conditions. It's a coordinated industry practice enabled by regulatory indifference, psychological exploitation, and media. The psychology is the foundation. Shrinkflation works due to the price-size illusion. Research shows consumers use price as the primary anchor for value, package size as a secondary heuristic. When price stays the same and package shrinks by 8%, most consumers don't detect the change. The threshold for noticing a size reduction is 15 to 20% for most consumers. Below that threshold, the change is perceptually invisible. Companies know this. Reductions are calibrated to stay below the detection threshold. This is psychophysics applied to profit extraction. The same science that tells you how much a light has to dim before you notice it dimming tells a food company how many chips it can remove from a bag before you notice it's lighter. Companies invest millions in this research. Every gram removed below the threshold is pure profit. It's a price increase that generates no consumer resistance because the consumer does not know it happened. The packaging design is the camouflage. When a company reduces quantity, it almost always redesigns the package. The redesign serves no functional purpose. Its purpose is to break your visual memory. You have a mental image of a cereal box, size, shape, color, graphics. When the company changes the graphic design, updates the logo, shifts the color palette, or modifies the box shape, at the same time it reduces quantity, your brain processes it as a new version, not a smaller old one. The redesign gives your pattern recognition system a plausible alternative explanation for why the box looks different. It looks different because it is new and improved, not because it is smaller. This is not accidental. Industry documents describe package redesign as a standard downsizing strategy. The new look is the disguise the smaller size wears to walk past your awareness undetected. The regulatory environment is structured to permit this. The Fair Packaging and Labeling Act requires net quantity. It does not require that changes in quantity be disclosed. A company can reduce cereal from 16 ounces to 14.8 ounces with no legal obligation to inform. The new weight is printed. The old weight is gone. No asterisk, no notice, no now with less label. Unlike the now with more label companies enthusiastically display when they increase quantity, the asymmetry is telling. When the product gets bigger, the company tells you. When it gets smaller, it hides it. The law allows this because it was written in 1966, concerned with fraudulent labeling, not systematic quantity reduction. The regulatory framework is 60 years old, never designed to address modern shrinkflation. Attempts to update legislation, like the Shrinkflation Prevention Act, have failed to advance. The grocery industry lobby consistently opposes disclosure, arguing net weight on the package is sufficient. It's sufficient in the same way terms and conditions you never read are sufficient disclosure. The information is technically present. The system is designed to ensure you never process it. The media treats shrinkflation as a curiosity rather than a crisis. When a news outlet covers shrinkflation, it is almost always framed as a consumer interest story. A reporter holds up 2 boxes of crackers and shows that one is smaller. The tone is, "Can you believe this?" The framing is tips and tricks for savvy shoppers. The implication is that shrinkflation is a problem individual consumers can solve by being more attentive, by reading unit prices, by switching brands, by shopping smarter. This framing is a lie. Shrinkflation is not a problem of individual consumer awareness. It is a systemic practice implemented simultaneously across hundreds of brands and thousands of products. By companies that share the same consultants, the same research, the same trade conferences, and the same profit incentive. You cannot shop your way out of shrinkflation any more than you can swim your way out of a rising ocean. The water is rising everywhere. Switching from one brand to another brand that has also shrunk its product by 9% is not a solution. It is treading water. The media frames it as individual because framing it as systemic would require naming the companies, quantifying the profit extraction, and questioning whether a regulatory system that permits invisible price increases is functioning in the public interest. That framing would threaten advertising revenue. The companies practicing shrinkflation are the same companies buying ad space on the networks covering shrinkflation. The structural conflict of interest ensures that coverage remains shallow, episodic, and focused on consumer behavior rather than corporate accountability. The inflation statistics themselves are complicit. The Bureau of Labor Statistics does attempt to adjust for quantity changes when calculating the CPI. It uses a method called quality adjustment and hedonics to account for changes in product size and composition. But the adjustment is imperfect, delayed, and systematically biased toward underestimating the impact of shrinkflation. The BLS samples approximately 80,000 items per month across 23,000 retail establishments. When a product changes size, the BLS agent must identify the change, calculate the per-unit price adjustment, and enter it into the system. This process relies on human observation in a retail environment where the changes are specifically designed to be undetectable by human observation. The same psychophysics that prevents you from noticing the smaller box prevents the BLS field agent from noticing the smaller box. And when the change is not detected, it is not adjusted, and the CPI understates the true rate of inflation. A study by researchers at the University of Leicester estimated that shrinkflation contributes an additional